$30,000 is sitting in your old 401k, and your landlord wants rent. Before you call the plan administrator and request a distribution, you need to know the number that almost nobody runs. That $30,000, left alone at a 7% return compounded monthly, becomes approximately $243,000 by the time you retire. That's the number this video is going to prove, and it's the number that should sit in your head every time cashing out your 401k feels like the only option. I'm Lockwood. By the end of this, you'll know exactly how much you actually receive after the IRS takes its share, what the compound opportunity cost looks like in real dollars over 20 and 30 years, and the two legitimate exceptions that let certain people skip the 10% penalty entirely. We're going to run the real math, not the headline figure. Here's the version of this that's playing out for a lot of people right now. Vanguard's How America Saves 2026 report, covering 1,400 plans, found that 6% of participants took a hardship withdrawal in 2025. That's triple the pre-pandemic rate and the sixth consecutive annual increase. The median hardship withdrawal was $1,900. Even that small amount, left invested at 7% for 30 years, would have grown to approximately $15,421. People are trading $15,000 of retirement money for $1,900 of immediate cash. That's the scale of the problem, and it repeats at every dollar amount. Before we get to the two exceptions that legally avoid the penalty entirely, let me show you the number that will actually change your decision. The exceptions only make sense against the baseline they save you from, and that baseline is the tax math. Take Maya, 37, project manager in Austin, Texas. Her company went through a reorg, she was laid off, and she's looking at a 6-week gap before her next role starts. She has $30,000 in her old employer's 401k and a rent payment due. She's weighing whether to cash it out. Her situation is real and common, and it's where the math gets specific. When Maya calls her plan administrator and requests a full distribution, the first thing that happens isn't negotiable. Because this is an eligible rollover distribution, the plan is legally required to withhold 20% for federal income tax at the time of payout. That's the rule under federal law, effective since 1993. On a $30,000 account, that's $6,000 withheld before the check is even cut. Maya receives $24,000. But that 20% withholding is just a deposit against her eventual tax bill. It is not the final number. Here's where the gap opens up. Maya is a single filer. In 2026, the standard deduction for a single filer is $16,100, and the 22% bracket covers taxable income up to $105,700, with 24% above that. A 401k distribution gets added to whatever other income you earn that year. Take someone who earns $95,000 in wages and pulls out $30,000. Gross income around $125,000. Taxable income roughly $108,900 after the standard deduction. And the top slice of that withdrawal lands in the 24% bracket. The point is that a large lump sum withdrawal in the same year as meaningful earned income stacks on top of your wages, and it can push dollars into a bracket you weren't expecting. Maya's year is lighter than that. A layoff and a 6-week gap between jobs put her income, withdrawal included, squarely inside the 22% bracket. 10% penalty on $30,000 is $3,000. Federal income tax at 22% on $30,000 is $6,600. Total immediate federal cost, $9,600. The plan already withheld $6,000. That leaves $3,600 Maya still owes the IRS when she files in April. What she actually settles for, $20,400 in her pocket, after the $6,000 withheld and the $3,600 she pays at filing. Her $30,000 account becomes $20,400 of usable cash. That's a 32% loss before she's bought a single thing. And if your year looks more like the $95,000 example, the marginal rate on part of the withdrawal climbs into the 24% range, which makes the settlement number smaller still. The takeaway isn't a single precise figure for every viewer. The takeaway is that the headline 10% penalty is not the real cost. The real cost is 10% penalty plus your marginal income tax rate applied to the full gross withdrawal, calculated before the withholding that already left your account. One more thing on taxes that barely anyone thinks about until April. The 10% penalty is calculated on the gross withdrawal, not the net check. Maya pays the penalty on $30,000, not on the $24,000 she received. And if she lives in a state with income tax, that state will usually want a share of the distribution on top of everything federal. Texas has no state income tax, which in Maya's case is genuinely fortunate. But if you're in a high-tax state, your total take-home on a $30,000 cash-out can be materially lower than even the $20,400 figure in this example. The exact additional cost depends on your state's rate. Run that number before you decide. This next part is where the real number lives, the one almost nobody runs before they sign the distribution form. That $30,000 left invested at 7% compounded monthly for 30 years grows to approximately $243,495. Maya is 37. If she retires at 67, that's exactly the horizon we're talking about. What she'd be giving up isn't $30,000. It isn't even the $20,400 she receives. The real cost is the gap between what the account would have become and what she walks away with. Now here's a comparison that makes the opportunity cost concrete on the net figure. That $20,400 check, the money she actually receives, if she were to invest every dollar of it at the same 7% for the same 30 years, it would grow to approximately $165,577. The in-plan balance would have grown to $243,495. The gap between those two outcomes is approximately $77,918. That's the real compound cost of the transaction, and it lives entirely in the opportunity the account no longer has. On a 20-year horizon, say cashing out at 40 and retiring at 60, $30,000 at 7% grows to approximately $121,162. Shorter horizon, still six figures, still a number that should give anyone pause. None of these numbers are meant to shame anyone. They're meant to give you the actual stakes before you make a decision that can't be undone. Hardship withdrawals are permanent. The money doesn't go back into the account. Every dollar withdrawn loses its compounding from the day it leaves. Now, two exceptions that the IRS does allow, and both of them are worth understanding before you assume a cash out is your only route. The first is the rule of 55. If you separate from service at your employer during or after the calendar year in which you turn 55, you can take penalty-free distributions from that employer's 401k plan. No 10% penalty. You still owe ordinary income tax, but the penalty disappears. For qualified public safety employees, that threshold drops to age 50. There are three things that matter here, and getting any of them wrong means the exception doesn't apply. First, it only covers the 401k at the employer you just left, not your old employer's plan from a previous job, not an IRA, only the plan at the company from which you separated at 55 or later. Second, if you roll that 401k into an IRA after leaving, you forfeit the rule of 55. The IRA doesn't carry the exception. Withdrawals from the IRA before 59 and a half would be subject to the 10% penalty all over again, unless a different exception applies. Third, the separation from service has to happen in the calendar year you turn 55 or later. If you left that job at 54 and you're now 55, the exception doesn't apply to that plan. Maya is 37, so the rule of 55 doesn't help her right now. But if you're in your mid-50s and considering a job change or an early retirement, this is worth knowing precisely. The second exception is Section 72T of the Internal Revenue Code, known as SEPP, Substantially Equal Periodic Payments. This one applies at any age, from an IRA or from a 401k once you've separated from that employer, which makes it the option for people who genuinely need income from their retirement account before 55. The way it works, you set up a schedule of substantially equal withdrawals calculated using one of three IRS-approved methods, and you take those payments without triggering the 10% penalty. The interest rate used in the calculation is capped at the greater of 5% or 120% of the federal midterm applicable federal rate, taken from one of the 2 months before your first payment. In mid-2026, that cap works out to roughly 5% either way, and together with your balance, your age, and the method you choose, it sets the payment amount you'd receive. The critical discipline with 72T is what happens if you stop. A SEPP election is irrevocable for the longer of 5 years or until you reach 59 and a half. If you modify or stop the payments early, the IRS recaptures the 10% penalty on every distribution you've already taken, plus interest. There are a few narrow IRS-permitted changes, a one-time switch of calculation method among them. But as a planning matter, you treat the schedule as untouchable. The whole point of the structure is that it's a commitment. It's not a tap you can turn on and off based on how the year goes. Maya, at 37, if she were to start a 72T program, would be locked into those payments until she turns 59 and a half. That's roughly 22 and a half years of fixed distributions from this account. And on a $30,000 balance, the calculated payments would be far too small to solve a short-term cash gap in any case. For someone with a large balance and a genuine need for an income bridge, 72T is a real tool. For someone in Maya's situation, with a short-term gap, it's the wrong fit. There are also a handful of narrower statutory exceptions that don't require a commitment. Since January 2024, Secure 2.0 added a penalty-free emergency personal expense distribution, up to the lesser of $1,000 or your vested balance over $1,000, once per calendar year, self-certified. It's a small number, but it covers a real emergency without triggering the penalty. And it doesn't repeat freely. Take one without repaying it, and you generally can't take another for the next 3 calendar years. One important caveat: plan adoption of this exception is not mandatory. Your plan may not offer it, so verify before you assume it's available to you. Secure 2.0 also added a domestic abuse victim distribution exception, effective January 2024, allowing up to the lesser of $10,000, indexed for inflation, or 50% of your vested account balance within 1 year of abuse, penalty-free. And there's a disaster recovery exception for federally declared disasters, allowing up to $22,000 per declared disaster for qualifying individuals who sustain an economic loss. These aren't loopholes, they're statutory exceptions that Congress added because specific hardship circumstances exist. If you qualify for one of them, use it instead of a full cash-out. Before you treat a full cash-out as the only move, there's one alternative that most people overlook in the moment: a 401k loan. If your plan allows it, you can borrow up to 50% of your vested account balance, or $50,000, whichever is less, repayable within 5 years with quarterly payments. No taxes at distribution, no 10% penalty, and the interest you pay goes back into your own account rather than to a bank. The trade is that the borrowed portion comes out of the market while you repay it. So you give up its growth in the meantime, which is still a far smaller cost than a cash-out. The catch, and it's a real one: if you leave your job while the loan is outstanding, the unpaid balance is typically treated as distributed. You then have until your tax filing deadline for that year, including extensions, to come up with that amount out of pocket and roll it into an IRA. Miss that window, and it becomes ordinary taxable income, plus the 10% penalty. So a 401k loan is a useful tool when you're staying at the employer, and a risk when your employment situation is uncertain. Maya's situation is a layoff. She's already separated from service. The loan option isn't available to her through this plan anymore. But if you're still employed and considering a cash-out, check whether your plan offers a loan first. Let me come back to where Maya ends up, because it's the kind of resolution that actually happens, and it's worth hearing. She has a 6-week gap. She needs approximately $3,000 to cover rent and immediate expenses. She doesn't need $30,000. She needs $3,000 for 6 weeks. She takes the Secure 2.0 emergency distribution of $1,000 from her 401k. Her plan does offer it, she confirmed. That's penalty-free. She owes income tax on it, but no additional penalty. For the remaining $2,000, she takes a short-term personal loan from her credit union to bridge the gap, which she repays as soon as her new paycheck starts. She talks to her landlord and arranges a 2-week grace period on the remainder of rent. The other $29,000 stays invested and untouched. That's the resolution that keeps her balance compounding for the next 30 years, rather than trading that future for $20,400 today. Now, a few practical points on how this actually works when you report it. When a 401k distribution is processed, your plan sends you a Form 1099-R at the end of the year. Box 7 on that form contains a distribution code. Code 1 means an early distribution with no known exception. Code 2 means an early distribution that qualifies for an exception the plan administrator already knows about, such as a 72T SEPP the plan is administering. If your form carries Code 2, that exception is already on record and no additional form is required. If your form carries Code 1, but you believe an exception applies to your situation, you file Form 5329 with your return to claim the exception and explain why the penalty doesn't apply. That's the form's purpose, to assert an exception the 1099-R doesn't already reflect. If you're wondering about Roth 401k accounts, the treatment isn't identical to a traditional 401k. Designated Roth account withdrawals recover contributions and earnings on a pro rata basis, not contributions first. The 10% penalty applies to the earnings portion of an early withdrawal, not to contributions that were already taxed. If you're considering an early distribution from a Roth 401k, get clear on what proportion of your balance is contributions versus earnings before assuming the penalty is zero. One more thing worth knowing. The One Big Beautiful Bill Act, signed July 4, 2025, made the current tax brackets permanent and changed nothing about the early withdrawal penalty, so the rates in this video are stable going forward. What the law also didn't change is how hard it is to put withdrawn money back. The 2026 employee contribution limit is $24,500, up from $23,500 last year, and for someone under 50, that's the most you can put back through payroll deferrals in a single year. Cash out $30,000 today, and it takes more than a full year of maximum contributions just to restore the principal, with every day of lost compounding in between. If you reach the decision that a distribution genuinely is the right move, run the actual receipt number before you call the plan. 10% penalty plus your marginal federal income tax rate applied to the full gross withdrawal. State taxes on top if your state levies them. The 20% mandatory withholding at payout is a deposit, not the final bill. Factor the true settlement into your cash flow before you decide the check solves your problem. The number that matters most in this decision is the one you don't receive, the compound value of the account at retirement. For $30,000 over 30 years at 7%, that number is approximately $243,495. The after-tax check is $20,400 in Maya's scenario. The gap between those two figures is the real cost, and it's the number most people never run. If this breakdown helped you see the decision clearly, a like tells YouTube to put it in front of the next person wrestling with the same choice. Subscribe, and the next decision breakdown lands in your feed. This video is educational content, not financial advice. Tax rules are complex, individual situations vary, and the numbers here depend on assumptions about income, filing status, and investment returns that may not match yours. Before you make a retirement account withdrawal, talk to a licensed tax professional or financial advisor who can run the actual math on your specific numbers.